Hello, everyone. Thanks for joining us this afternoon. My name is Dave Lubnick, and I'm joined here with Molly Fernandez. And we're excited to bring to you the YCharts Fund Flow Review for the first quarter, as well as March. This is something we did back in February for the fourth quarter of last year, as well as the year of 2021 in review. Had some rave reviews about it, some great attendance. So we're happy to bring this to you again to highlight the first quarter and take a look at what our clients are seeing. I represent the asset management vertical, so we've got a lot of wholesalers looking at this fund flow data on a daily basis, weekly, monthly basis. Very excited about it. And Molly represents our RIA segment, working with advisors and financial advisors as they leverage YCharts for all kinds of needs, but in particular the fund flow data. So we're excited to have you here today representing some of the 2,000 wholesalers and almost 8,000 advisors leveraging YCharts. And without further ado, let's dig in. So we're going to start off by looking at March here. And what we're looking at here are the broad category asset flows for mutual funds and ETFs in the month of March. What you'll see here is that in March, there was a huge inflow for equities and a large outflows for fixed income. This was interesting because when you think about this in the context of the category and kind of performance of what happened so far in April, as we sit here on April 27th, it's interesting to look at the performance of equities and fixed income with 2020 hindsight. So we saw the huge inflows into equities in March. Unfortunately, as we sit here, market's up today, but the S&P 500 as a whole, month to date in April, is down about 6%. So those inflows into equities in the month of March, as of right now, don't look like they were timed all that well. Fixed income, on the other hand, appears to be well timed. Barclays Ag down about 3% month to date here in April. The outflows from fixed income obviously missed that dip, which is a good thing to see. The other thing I'll mention here related to money markets. You see money markets in blue bringing in about $7 billion in the month of March. That's notable because in January, money markets lost $138 billion, and in February, money markets lost $38 billion. So while $7 billion of inflows might not seem like that much, it was quite a reversal from huge outflows that we saw in January and February.
That's interesting, Dave. Yeah, I think, like you said, hindsight being 2020, I think March was the first positive month for equities this year, and fixed income it was down year to date come the close of the quarter. So pulling out of fixed income, like you said, made sense, and maybe investors looking to pile on some more risk into their portfolios, moving into equities and hope to ride those gains going forward. So far, that hasn't quite been realized outside of March with the sustained volatility this month. This slide next will look at what we were just looking at from a March perspective now for the quarter as a whole. And you'll see it's a pretty similar story here, notably with money markets swapping out from where they were in the inflows to the outflows here, like Dave mentioned. But overall, a strong move out of fixed income and money markets into the equity markets, which is a reversal from 2021 and even Q4 of 2021, where most of the money was inflowing into those money market and fixed income areas. Like we said, maybe a little bit of levering on of the risk as we came out of the volatility of the first couple of months. Something that could be occurring here is after that volatility and some of that March positivity, investors thinking that the market may gain a lot of steam. We saw in 2020 a strong comeback and a really quick market comeback. Maybe a little bit of recency bias that comeback might be here quicker than it is, and could be a longer return to kind of less volatility as we used to see in the past prior to 2020. That being said, like Dave mentioned, we did still see positive inflows into money markets in March, so not totally risk on and full steam ahead into those equities.
Yeah, and the only thing I'd add here, again, looking at the money market breakdown between January and February, huge outflows, March, a little bit of an inflow. I can't help but chuckle a little bit because as a former advisor myself and knowing a lot of advisors are on this webinar right now, I feel like the number one principle that advisors tell their clients is to stay invested for the long term. But yet we see what appears to be some efforts for some market timing. So I just found that interesting. Now we're going to look at, again, just March here, but let's look at equities in specific terms here and across the 9 equity style boxes. What we see here, as you can visualize, is just a huge inflow for large caps. Value, blend, growth, all up significantly in March, with large blend in particular leading the way. And then what's interesting is when you look across the mid caps and small caps, you see a little bit of that trend as well, where blend is leading the way compared to value and growth. You can hypothesize why that might be. Perhaps it's that folks are a little weary of large caps and the outsized role that some of those play in portfolios. YCharts actually just released a white paper a few days ago on exactly that, the kind of overweight impact that some mega caps have on performance within a portfolio. And as a side note, if you want to take a look at that white paper, which has drawn rave reviews so far, you can find that at YCharts.com. But then also I wonder with value, if despite the downturn, folks are still maybe a little squirmish to catch the falling knife, if you will, and that might be hence driving them a little bit more towards the blend category.
Interestingly, too, here, this was actually the first month of 2022 where large growth has seen inflows. That category that's been doing so well recently and in the past few years and really driving some high performance numbers. Didn't see some of that inflow that it is now seeing. So we're continuing to see that kind of levering on into maybe those more risky spaces in March. That being said, it was supported throughout March, that some of that move, using QQQ as an example of a large growth fund here. QQQ was down 12.83% through the end of February, and then had returns of about a 4.5% or so in the month of March. So well timed from that perspective. But like we're saying, with that continued volatility in April, QQQ is now down this month another 12.5%. So maybe some little bit early movement into that space. And then looking here at this slide of flows as a percent of AUM into these various different equity styles tells a pretty similar story to what we were seeing with that previous graph on the last slide. Not a lot of movement between these different equity styles, largely just consistently seeing inflows into that large cap equity styles and kind of a mixed bag in mid cap and small cap. What's interesting is that we do see those almost consistent percent of AUM inflows into all of the large cap categories. That's not necessarily backed up by how they've been doing so far this year. Through the quarter, large cap value was up 1.32%, and then growth and blend were both down. Growth was down by almost 10% and blend down by almost 4%. So pretty significant differences in terms of the returns within those different styles, while they continue to see the same inflows. This might be driven by something like the beginning of last year. We saw large growth, or large value, I should say, come out to a strong start in terms of performance, and a lot of talk around it and hearing advisors mentioning it during that time period. But then it still ended up being large growth that kind of finished the year strong and came out on top. Maybe a little bit of sentiment that might be occurring again here this year.
Yeah, and I'd ask everybody to keep these percentages in mind, because we're going to show you this a little later in the presentation with some much larger numbers to kind of put things in perspective on that later slide of how outsized that slide reflects. But keep in mind here, we're all talking about everything less than a percent here. The items that catch my eye related to small caps, as there, obviously is concerns about slowing growth rates, rising inflation, geopolitical risks. If there is a recession around the corner, which some Wall Street firms are starting to kind of put a higher probability on, you wonder if folks are kind of pulling out of the small caps, which would be potentially hit the hardest as we would potentially enter a recession. The next slide is one of my favorites in YCharts. And for those of you that subscribe to our monthly fund flow reports, this might look a little familiar, and we'll show you an example of one of those in a few minutes. What we're doing is we're breaking down those 9 style boxes, but for the month of March, rather than looking at them from an aggregated level, we're breaking them down between mutual funds and ETFs. And I love this visual because it tells such a compelling story. The fact is, across 9 style boxes in mutual funds, only one of them was positive, and it was barely positive. Across 9 style boxes in ETFs, 8 out of the 9 were positive, with only 1 being negative. So you can see here that as a money manager, you certainly want a broad lineup of securities, and you probably want some ETFs right now, because regardless of which style box your mutual fund is fitting into, it's tough sledding right now from an asset gathering perspective, whereas certainly some tailwinds behind ETFs.
I think it's interesting too, looking at the scale of these numbers between ETFs and mutual funds. We can see beyond just having more inflows than mutual funds, those ETFs are having significantly more inflows. And if we stick into just that kind of ETF large cap space though, and compare this to February, in February, large value had inflows of 15 billion compared to 9 billion here. Large blend had inflows of 32 billion compared to 25 billion and change here. And large growth only had inflows of 230 million into that space. Taking the difference there and kind of taking the mutual fund part out of it, we can see most of those large blend and large value flows that were previously being received into those categories, most likely shifting into the growth ETFs this past month. And then moving on into sectors here, this is actually an area that I speak a lot with different advisors in my day-to-day, simply because I think is one of the areas most influenced by kind of current events and different economic situations that might be going on here. Looking at this graph, we can see that natural resources is taking kind of the lion's share of the inflows in terms of sectors from this past month, with energy and financials, I should say, and real estate really bringing up the bottom there with significant outflows. That's a bit of a reversal from what we saw last year, where financials and real estate were received the most inflows of any of the sectors. Those are two areas that are probably going to be hard hit in rising rate environments and also by inflation, two things that we're experiencing right now. You take natural resources, on the other hand, with current geopolitical events possibly driving up demand and inflation continuing to drive up prices within that area. The flows here are kind of natural off of those different economic situations that we're seeing appear both in the US as well as globally.
Yeah, and just to highlight real estate a little bit more, again, I think it's interesting to note kind of just the transitory nature of these flows and the fickleness of them. If you looked at real estate in the fourth quarter, they were basically tied for first for inflows with technology. So you saw real estate kind of being the primary equity sector for inflows in the fourth quarter. But yet here we are looking at March, and we're seeing them basically tied for last. So it's interesting to see. There's not a whole lot of consistency within these sectors from month to month or quarter to quarter. Before we dive into the next slide, let me also just make a mention here that if anybody has any questions, please submit them through the Q&A box in Zoom here, and we will be happy to field those at the end. This slide here now, looking across the Q1 sector flows. So taking it out from March to all of the first quarter, you see here technology leading the way. And interestingly, natural resources coming up in the rear there, which is fascinating because you look back at March here for a second and they were number one. So they're number one in March, but they're in last place for the first quarter. Again, interesting to look at. So now again, with hindsight being 2020, let's look at the returns of natural resources kind of for the first 4 months here of the year. In January, natural resources up kind of 3 to 4%. February up about 4% again. March up 8%. And then in April, natural resources are down about 6% month to date. So you have a situation where you saw massive outflows in January and February from natural resources. Those are the months, January, February, March, that natural resources as a sector performed very well. And then you see all of those inflows in the month of March. And here we are in April with negative performance of about 6%. So just goes to show you timing's tough.
And I think on the other hand of that, where timing may have been correct is going to be with those energy outflows. Energy returned about 39% on the quarter. It was the top performing sector over the first quarter of this year. That means that maybe those gains were realized by some of those investors before they pulled that money out and are now investing it elsewhere. Maybe some of that money going into natural resources. Moving on to the kind of fixed income categories here and focusing on the flows into those areas, we can see that overall we're seeing inflows into long government, bank loans, intermediate core bonds, outflows from every other category. This can probably be attributed to the period of rising rates that we're most likely entering into. The shift of those categories that are receiving inflows typically do well in a rising rate environment, such as bank loans, which benefit from those rising spreads, or widening spreads, I should say. Interestingly, though, long government so far is the worst performing category within fixed income through the first quarter. It's actually down 10.63% on the year. So if that ends up being a positive return going forward in those rising rates environment, those investors might benefit from the discount at which they're purchasing it right now.
Yeah, speaking of long government, that certainly has been a trend that we've seen for a while now. We're going to show you in a couple slides the first quarter flows, and you'll see long government in second place. So here they are: strong flows in March, strong flows in the first quarter, strong flows in the fourth quarter of last year. So long government has certainly been a popular sector here. Let's look now at the next slide, which is going to put this in percentage terms. And I asked you a few minutes ago to kind of keep some of those equity category percentages in mind. We saw all of them less than 1%. Here we see some pretty significant numbers across the fixed income sectors. We see several numbers greater than 1%, and we see long government there at 9.5%. So think about that. Long government has had huge inflows in March, which this depicts, but also the first quarter as well as the fourth quarter. If you go back to middle of last year, long government as a sector regarding their assets was a fraction of where it is today. So clearly large inflows into large government. The other one I'd highlight is bank loan. It feels like every conversation I'm having right now with one of our wholesalers is around floating rate products. A lot of momentum behind the bank loan category. Performed historically pretty well in rising rate environments, using YCharts to depict that back in kind of 2017, 2018, has been a key feature for wholesalers. So it's not surprising to see the flows into bank loan there in March as well.
I think it's interesting too to look at the categories as a whole within here. Overall, we're seeing inflows into long-term and intermediate fixed income categories and outflows from those shorter-term fund categories. And that's true across the board, depending on kind of the sector, or I should say, regardless of the sector that those fixed income categories are covering. Just an interesting note there that long-term and intermediate seem to be faring better than short-term is, and at least in terms of those flows. And like Dave mentioned, we can see here now those Q1 fund flows into the fixed income categories as in total. As you can see, bank loans, intermediate core bonds, long government, same story that we're seeing here in terms of inflows as we saw for March, mainly being that kind of bank loans and long government are kind of swapping places here as number 1 and 2. One thing that is of interest here is that we'll see bank loans in the top position there with 19.5 billion in flows over the quarter. They did only have 3 billion of flows within March. So maybe some petering off of those fund flows as investors have kind of gathered into that category. But still, we can really see those same categories continuing the trend throughout the quarter that we saw in March. No significant change within here.
That's right. So with a few minutes left here, I want to touch on the monthly fund flow reports that we produce that automatically get sent out to all of our clients. You also can download them through the website and look at historical months going back for the last couple of years. As I mentioned earlier, these reports are very popular. There's 2 reports. So these are based on monthly data. The fund flows for each security are typically updated within a couple of days of month end. However, we wait to compile these reports and send them out till usually about the middle of the month, just to make sure that all of the flows are there. There are 2 reports. This report right here highlights the mutual fund categories with the largest inflows. So what we're looking at here is the month of March, looking at money markets leading the way with the 7 billion of inflows, followed by core bond, bank loan, long government, and diversified emerging markets. And then you can see within the category, the 5 specific mutual funds that had the largest inflows. So this is a great report to kind of see which categories attracted the most assets for the month. The next page is now going to highlight outflows. So we see multi-sector bond leading the way in March, followed by short-term bond, ultra short, core plus, kind of what Molly was just talking about there, as well as the specific funds that were losing the assets. And then we've got two more pages highlighting the ETF categories with the largest inflows, and then the ETF categories with the largest outflows. Molly, anything you could add here?
Yeah, I just think it's interesting looking at this. It kind of goes to our point that we were making earlier about ETFs and mutual funds. If you look at the categories with the most inflows for ETFs versus the categories that have the most inflows for mutual funds, they're vastly different. ETFs really hitting on all of those large cap equity styles, whereas we see kind of money markets and some of those fixed income categories under the mutual funds. So the areas that are receiving the most investment, as we've talked about, are going into the ETFs, and those that are kind of receiving fewer inflows nowadays is still being kind of dominated by the mutual funds. So I think that's an interesting dichotomy between the two there.
Yeah, absolutely. And then the second PDF report that we produce on a monthly basis looks at pretty much all of the Morningstar categories. And it's a nice, concise 2-page report. And it looks at kind of what we looked at a little bit earlier in the presentation. We look at the categories at a combined level, but then we break them down between mutual funds and ETFs. So you got a perfect visual example here of large value having about 8 billion of inflows in the month of March. But then when you break that down just right below that, you can see mutual funds were actually out 1.6 billion and ETFs were in 9.6 billion. So this is a great report to look at the combined flows, but then breaking them down between mutual funds and ETFs. And again, we do this for pretty much all of the sectors that we cover.
I think something nice that's about this report as well is that it does show those category returns. So you get a little bit of performance information as context for the fund flows. If you scroll down just a little bit here, we'll come across those sector information within the US equities. What's interesting here, and kind of going to what we talked about recently, the areas that have seen consistent positive returns in terms of those sectors over the past year has been energy, natural resources, real estate, and utilities. Interesting enough, for those different areas, all but one of them was receiving positive fund flows over the past month within March. And the one that's been missing out recently has been real estate. We talked about earlier how that's been kind of bringing up the rear. Interesting to see that some of those negative returns haven't quite been realized within that space. It was still actually positive over the past month, even while experiencing significant outflows.
Yeah, absolutely. And then the last thing I'll show you here is the fact that every sector here is actually a hyperlink. So this hits your inbox once a month, but then you can click into any of these sectors, any of these categories, and it'll actually pop you into YCharts. And then you can dissect the data even further. So this right here is looking at the large value space. And you see, all right, T Rowe led the way with 2 billion, followed by Bridge Builder, another T Rowe, Newberger, et cetera. So this is a great way to leverage those PDF reports in your inbox, but then take them into YCharts, look one step further down from a granularity perspective, looking at the funds. You can add additional columns here, add additional columns for timeframes of flows, but also maybe add some performance columns where the inflows due to great performance or something else. Add expense ratio in here, add fundamentals, risk metrics, whatever it might be. So that's the power of YCharts, is that hits your inbox, but you can take it here. And across the spectrum, wholesalers, divisionals, nationals, heads of distribution, all love these reports because of the timeliness of them and the succinct views in those PDF reports, but then this next step of being able to dive a little deeper. Molly, anything you'd add from your client-based perspective here?
No, I think this is great. It's great to use it as a jumping off point from the fund flows, and then to continue to add columns, look at information within here. And worth noting too, that you can always take these steps with any funds that you might hold within your portfolios or within your watch list that you like to keep an eye on. Not only can you view this on the category level, but if these are your portfolio holdings and you want to view fund flows across those groups, that's always a possibility as well. Can really be customized to those securities that you want to drill down into.
Absolutely. Well, wonderful. With that, we're going to wrap up. Although actually we have one question, great question here from one of our Canadian clients on whether or not we cover Canada with these flows. The answer is yes. Apologies, this webinar was geared towards the US flows, but everything you saw here applies to Canadian flows as well for both mutual funds and ETFs. We have those in depth in the PDF reports as well as the website. So let us know if you want to get your hands on any of those. You see some links here on how you can subscribe to those fund flow reports if you're a client of YCharts, as well as visit the fund flow library in the website. If you're not a YCharts client, visit YCharts.com. You can sign up for a free 7-day trial. And with that, we thank you for your time. We'll look forward to seeing you again for the next iteration of this webinar. Take care.